Welcome. Today we're diving into Ipsas 40, the international standard that finally brought clarity to how public sector entities account for mergers and acquisitions. Before Ipsas 40, governments used inconsistent methods, making it hard to compare financial statements or assess the true impact of combinations. Ipsas 40 sets clear rules for mergers and acquisitions, ensuring transparency and accountability in public sector financial reporting. In this video, we'll break down the key concepts, walk through practical examples, and show you how to apply Ipsas 40 in real-world scenarios. If you find this helpful, don't forget to subscribe for more Ipsas tutorials and updates, so you never miss out on the latest in public sector accounting. Ipsas 40 defines two types of public sector combinations: mergers and acquisitions. In a merger, no single entity gains control. Think of it as a partnership of equals, with shared management and joint oversight. In an acquisition, one entity takes control over another, usually by obtaining a majority of voting rights or through contractual power. The distinction is crucial. Mergers use the pooling of interests, book value method, while acquisitions use the purchase-acquisition method, measuring assets and liabilities at fair value. Correctly classifying the combination shapes the entire accounting approach. Let's see how these methods work in practice. Next, we'll explore the pooling of interest method for mergers. For mergers, Ipsas 40 requires the pooling of interests method, combining the book values of assets and liabilities from each entity. No revaluations, no goodwill, just a straightforward uniting of equals. Example: Library A and Library B merge to form Central Regional Library. Their assets and liabilities are simply added together at book value. The journal entry debit total assets, credit total liabilities, and credit equity for the combined net assets. This approach reflects continuity and preserves the historical cost basis. The result? A consolidated balance sheet that truly represents a merger of equals. Now, let's see how acquisitions are handled differently. In acquisitions, Ipsas 40 uses the purchase method. Assets and liabilities are measured at fair value on the acquisition date. The acquirer records what it pays, the consideration, and recognizes any difference between that and the fair value of net assets as goodwill or a bargain purchase gain. Example: Agency X acquires Agency Y for $1 million. Y's net assets at fair value are $900,000. The extra $100,000 is recorded as goodwill. Goodwill captures intangible benefits like reputation or synergies. The journal entry: debit assets at fair value, debit goodwill, credit liabilities at fair value, and credit cash for the purchase price. This method gives a more accurate economic picture of the transaction. But what if the acquirer pays less than the net asset value? That's a bargain purchase. A bargain purchase occurs when the acquirer pays less than the fair value of net assets acquired. Before recognizing a gain, Ipsas 40 requires a thorough review to confirm all values are correct. If confirmed, the gain is recognized immediately in the surplus or deficit. Example: Agency X acquires Agency Y's net assets worth $900,000 for only $800,000. The $100,000 difference is a gain, boosting Agency X's surplus. This ensures transparency and highlights the financial benefit of the deal. Ipsas 40 demands detailed disclosures for all combinations, ensuring users understand the nature and impact of each transaction. For acquisitions, disclose the acquiree's name, date, reasons for the deal, voting rights acquired, consideration paid, and amounts for assets, liabilities, and goodwill or gain. For mergers, disclose the names of merging entities, merger date, and the book values of assets, liabilities, and equity contributed by each party. These disclosures help stakeholders assess the rationale and financial effects of the combination. Ipsas 40's clear framework distinguishes between mergers and acquisitions, shaping how assets, liabilities, goodwill, and gains are reported. Rigorous disclosure requirements promote transparency and accountability in public sector financial management. Mastering Ipsas 40 ensures public sector combinations are reported with clarity and integrity.